Over time, workers could be missing out on hundreds in tax savings. Have you worked overtime during 2025? If the answer is yes, stop what you're doing for a moment because there may be money waiting for you when tax season arrives. And surprisingly, many workers have absolutely no idea. Every year, millions of Americans put in extra hours. They stay late, cover extra shifts, work weekends, and sacrifice time with family to earn more money. But what if some of that overtime work could help reduce your tax burden? Today, we're breaking down what every overtime worker should know before filing their taxes. Let's get started. First, understand something important. When you receive overtime pay, your employer usually withholds taxes from that income just like regular wages. That means throughout the year, money is automatically taken from your paycheck. Most people never think about it. They simply see the deposit hit their bank account and move on. But here's where things get interesting. Depending on your situation, part of the overtime premium you earned may qualify for special tax treatment when you file your return. And that could potentially increase your refund or lower the amount you owe. Now, before you get too excited, let's clear up a common misunderstanding. Many people hear phrases like tax free overtime and assume every dollar of overtime income becomes tax free. That's not how it works. The key detail is the overtime premium. Let's look at an example. Imagine your regular hourly wage is $30 per hour. When you work overtime, you might earn $45 per hour. That extra $15 per hour is known as the overtime premium. The premium is the difference between your regular pay and your overtime pay. And that's the number that matters, not the entire overtime paycheck, just the premium portion. Let's say you worked 100 overtime hours during the year. Your overtime rate was $45 per hour. Your regular rate was $30 per hour. The premium difference is $15. Multiply that $15 by 100 overtime hours. That gives you $1,500. That amount becomes extremely important when calculating potential tax benefits. Now, here's the challenge. Many employees don't even know how many overtime hours they worked throughout the year. That's why your first step should be reviewing your pay records. Pull up your most recent pay stub, look for year to date earnings, look for overtime hours, look for overtime wages. The information is usually there if you know where to look. If your pay stub shows overtime hours, great. The math becomes simple. But what if it doesn't? Don't worry, there's another way. Take your total overtime earnings and divide them by your overtime hourly rate. That gives you an estimate of the total overtime hours work done. From there, you can determine the premium portion. This may sound complicated at first, but once you understand the process, it's actually straightforward. Now, let's talk about something many people misunderstand. A tax deduction is not the same thing as a tax credit, and that difference matters. A tax credit directly reduces your tax bill dollar for dollar. A deduction works differently. A deduction reduces the amount of income that can be taxed. Think of it this way: a deduction shrinks the size of your taxable income. A credit directly attacks the tax bill itself. So when people hear about overtime tax deductions, they often expect thousands of dollars back. That's usually not how it works. The actual benefit depends on your tax bracket. The higher your tax bracket, the more valuable a deduction can become. Let's imagine two workers. Worker A is in a lower tax bracket, worker B is in a higher tax bracket. Both claim the same deduction. Worker B may see a larger tax savings because their marginal tax rate is higher. That's why understanding your tax situation is so important. Now, let's discuss income limits. Many government tax benefits come with restrictions, and overtime related deductions may be subject to income phase outs. In simple terms, once income rises beyond certain thresholds, the benefit may gradually decrease and eventually disappear completely. That's why high income earners should pay close attention to qualification rules. The last thing you want is to assume you're eligible, only to discover later that your income exceeds the limit. This is one reason many people choose to consult a tax professional before filing. A good CPA can often identify deductions and opportunities that taxpayers overlook. Now let's focus on what you should do before tax season. Step 1, review every pay stub from the year. Step 2, identify your overtime earnings. Step 3, calculate your overtime premium. Step 4, keep accurate records. Step 5, discuss the numbers with a qualified tax professional if needed. These simple steps could help ensure you don't leave money behind. And that's really the point. The most people work incredibly hard for their income. If you've spent months working extra shifts and sacrificing personal time, you deserve to understand every tax benefit available to you. No one wants to overpay taxes. No one wants to miss legitimate deductions. And no one wants to discover later that they could have saved money if they had simply prepared ahead of time. The good news is that preparation doesn't require advanced financial knowledge, it simply requires awareness. The sooner you review your records, the easier tax season becomes. So, if overtime was a big part of your year, take a few minutes today and gather your information. Future you will be glad you did. And when tax season arrives, you'll already be one step ahead of most taxpayers. Thanks for watching. If you enjoy practical money tips, tax strategies, and personal finance content, make sure to subscribe because understanding money isn't just about making more, it's about keeping more of what you earn.